Hello, welcome to this episode of the Financial Incline. I'm your host, John Bovard. Today, I'm thrilled to share with you a webinar that we did called the Business Owner's Guide to Wealth. So during this webinar, we touched on 5 key steps that you can take when you're building your business or preparing to launch your business that can help you to build wealth both personally and for your business. So some of these steps that we discuss are: the end is the starting point. So making sure that you have an end result that you want to maintain for your business, identifying the correct structure for your business, whether that's an LLC, an ownership, an S Corp, a C Corp. Also, making sure that you don't overlook retirement plans, making sure you have the correct retirement plan set up in place, and a couple of loopholes that you may not know about when it comes to company retirement plans that you can use to really boost your personal wealth. Increasing the value of your business, and then also deciding when to partner with a financial advisor. So there are a couple key levers that you can take to help to increase the value of your business when an acquirer or someone you might sell the business to begins to evaluate your business and look under the hood. So looking at a couple of ways that you can increase the value of your business is very important as you are setting up your strategic business plan. So I hope you enjoy this webinar presentation. If you like the video, make sure you subscribe to our YouTube channel where we post regular content that can help business owners and other investors with growing their wealth. Thanks a lot, and I hope you enjoy. So thank you everybody for joining today. What we will be discussing, as you can see here, is the Business Owner's Guide to Wealth. So what we'll be covering are a couple of strategies that you can look to use for your business to help with growing not only your personal assets and retirement accounts, but also helping to increase the value of your business. So again, this presentation is mainly these are ideas, right? So things that I've seen through working with clients, also through different research that we've gathered, and then also what I've seen firsthand at the company Game Master Athletic as well. So we'll reference a couple of things and then share with you some ideas of how these might be applicable to you. Hopefully there's some thought-provoking things that you haven't necessarily used or incorporated yet in your business that you can take back and implement these different ideas. So first off, we'll go ahead and get started. And what I'm going to lay out to you today are basically 5 different steps to keep in mind when you're thinking about your business planning process. So for many people, their business may be their only source of retirement plans, but you want to make sure that you can walk away or you have things that are set up in place for you in case something happens as you're nearing retirement with your business. I have known several business owners that maybe they didn't necessarily save a lot or have a big enough nest egg built up going into retirement, and then the business landscape changed. So, one in particular that I know of is they were selling to Amazon. Amazon basically let them know they were going to discontinue sales to them, and that really threw off their retirement plan, and because it drastically decreased the value of their company. So make sure that you have these 5 steps that we're going to lay out in place and taken care of as you are building your business and as you're working throughout your career. So first and foremost, a lot of people say this when they're running a business, is to start with the end in sight. So know what you're going to do with your business. So early on, I know how important it is to make sure that you're looking at, okay, how do you want to set up your business? How much time do you want to spend traveling? What does your work-life balance hopefully look like? Are you looking to, operate this business on a day in and day out basis? Do you maybe bring in partners or bring in help? So at the early starting point of your business, what does that look like for you? And then the middle of your career, these are typically what we refer to as your accumulation years. So what do you want your life to look like? Where do you want to live? How do you want to spend your time? And really, how are you going to save up enough money or grow your business enough that it can support you for the rest of your life? And then legacy. So that's your exit, right? What is your exit planning strategy going to be? What is the goal? What are your expectations for this business? How do you get there? And then how do you potentially have a successful exit? And we'll talk about the different exits that you can have, but how do you want your business to be remembered? Is there a certain, do you want to bring your kids into the business? Is there a certain seller in mind, certain buyer for your company that you look to have? Or do you want to structure it a different way, or maybe your employees can get some ownership? So again, step one is to make sure you look at what would be a successful exit for you, and what are your true intentions for your business. And obviously these can change throughout the years. It can, one day you might decide, hey, I'm going to run this solo. The next day you might decide I'm going to bring in a partner. These can obviously change throughout time, but make sure that you know what you're looking for, what you're looking to get out of your business. So one key thing is, how would you want to exit your business? And there's obviously a multitude of different ways that you could potentially sell your business. For many people, if it's a family-owned business, maybe they'll bring their kids or some other relatives, nieces, nephews, whoever, into that business and really pass the business on that way. Or if you're running the business and you have, certain people that you could pass this business on to, maybe you can sell to an internal partner. Or, as we mentioned on this slide here, employee stock ownership plan, maybe it makes sense for the employees to buy the companies from you. There are great tax advantages around an ESOP and structuring the sale that way, where you can really reduce your taxable amount when you go to sell the business. And then it also keeps the company running and continue on with your legacy, and can motivate employees upon your exit to make sure that they're continuing to run the business successfully and carry on your legacy. One key important item to remember: if you recently acquired a business, if you started a business, or if you have been in the business for a long time and maybe some ownership shifts or changes have happened, one item to make sure you have in place is a buy-sell agreement. So a buy-sell agreement can structure how exactly that business will be passed on if anything were to happen to one of its owners. So if you have yourself and maybe two other partners, or even just yourself, and you may be looking to sell the business or bring somebody into the business when you're ready to exit, having a buy-sell agreement in place is an important structure to have, because it will determine how you will value the business at the time of that exit, and then who could potentially buy this business from you, and most importantly, at what price. So you may think the business is valued one way, your partners may value the business a different way. Maybe they use a discounted cash flow model. Maybe you want to use more of an asset model to value the business. But having a buy-sell agreement in place right up front can really dissolve any of that uncertainty and can lay out exactly how the business will be valued when you're ready to exit. So make sure, if it's yourself or if there's partners involved, that you have a buy-sell agreement in place. So identify the correct structure for your business. So obviously there's a choice of different structures that any business has. And really some of the key important factors with these are taxation and liability. So if you are looking at ways to reduce your personal liability and make sure that your business is unrelated to any personal things like your home, your cars, any personal assets, making sure you have an LLC set up is obviously, it's vitally important for that. One thing to look at as well is, as your business grows, it's recommended by most accountants that once you get to that 150 to over 200,000 in annual revenue, to really start to look as to making that S Corp election. So an S Corp election can be very beneficial for you. Your payroll taxes, your Social Security taxes are on your salary amount, and they are not necessarily on distributions that you take from the company. So looking at setting up an S Corp is definitely what I see most often for businesses that I'm working with. Partnerships, one thing to keep in mind with that, if you do take distributions from a partnership, those all have to be equal. So every partner has to take an equal amount or an equal percentage of distributions when the time comes for that. And then there's C Corps. So C corporations typically see these with larger companies. One thing to look to avoid with a C Corp is the potential for double taxation. So being taxed at the business level and on your personal level as well. But again, it's important to identify what the correct structure for your business will be. One thing that is not as well known as it potentially should be or could be, and it is an important structure to consider for your business, would be looking at a qualified small business stock. So for qualified small business stock, imagine owning stock in your company where the price can greatly appreciate, and at the time that you sell it, you may not have to pay any taxes on that business when you sell. So the way a qualified small business stock company works is you can, if you were to sell that business and you have it set up as an S Corp and a qualified small business stock for at least 5 years, you could potentially get up to $10 million of those business proceeds completely tax-free. Anything above and beyond that would be taxed at capital gains rates. So there are some requirements and things to look at if you're looking to set up a qualified small business stock. First and foremost, your entity structure, you must be set up as a C Corp. So that's why on the last slide I mentioned looking at potentially starting a C Corp. And this is one of the true benefits of having your business be taxed as a C Corp, is if you can set it up with this qualified small business stock. Assets must be $50,000 or less, and the corporation obviously must be an active business. But for those of you out there that maybe have an S Corp and might consider changing to a C Corp, this is definitely something that you can look into once the business is a certain size and obviously below that 50 million in assets. So something to consider. Taxation of a C Corp, maybe potentially look at a qualified small business stock. The next step to look at and to consider, like we talked about what would be your potential exit strategy, what is the structure, the entity structure of your business. Third thing to look at is your retirement plans. So as a business owner, you have a multitude of retirement plans, and it is vitally important to have this liquid nest egg built up over time for you so that you're not solely relying on an exit from your business to fund your retirement. So make sure that you have a retirement plan set up in place. There's a multitude of different benefits that are involved with this. First and foremost, it can be used to lower your taxable income for the year. And then also it can attract and retain employees, and it helps to diversify your investments, right? So if the majority of your assets are tied up in your business, this can give you another form of investing by putting that money in the retirement account and investing it in different stocks or bonds. I typically suggest investing more heavily into stocks than bonds, especially for people younger in their career. But it's important to consider the benefits and advantages of a retirement plan. So the different retirement plans, and really important thing to consider, I would say, size of company and revenue when you're looking at these different types of retirement plans. So first and foremost, the plan you see up top there, the 401k, these are the most popular. These are the ones you hear about the most. But these are as your company is growing and maturing, because there are costs involved to the 401k. So there's administrative cost. You have to be a trustee. You have to meet certain testing and requirements for setting up a 401k plan. And typically these costs, if you hire an advisor as well, if you're operating a 401k plan, the cost for that may be $10,000 to $15,000 every year in costs for owning and operating that plan. One of the key benefits of the 401k plan is the ability to have the largest amount of contributions. So 401k, 403b, and solo 401k, you can put more money into these. Your employees can put more money into these as well than you can with a SEP IRA or a simple IRA. So a SEP IRA is good for people that are individuals, that it's just them. The SEP IRA, the solo 401k are good options for that. If you're a sole proprietor, you're the only one running your business, solopreneur, look at a SEP IRA and a solo 401k as your options there. if you have a few employees and you're looking to do some sort of company match, if you're below 100 employees, that's the rule with the simple IRA. So start to look at that simple IRA as you start to have multiple employees, and if you're looking to offer some sort of company match as well. So now I wanted to get into, so with the 401k, there's a couple of things that I wanted to make sure that I highlighted here for business owners, because one of the things that's important for most business owners is what are some ways that they can shield their income? So how could they potentially reduce the taxable income that they have now and defer those taxes down the road to when they're potentially taking that money out? So one thing to keep in mind, the contribution limits have gone up. This is the largest increase ever by the IRS for from year over year of how much you can contribute to a 401k. So for those under 50, you can put up to $22,500 into the 401k. If you're over 50, you can put an additional $7,500 in there, making your total employee contributions for those over 50 up to $30,000 every year. Then to keep in mind, as a business owner, you can also make employer contributions. So these are primarily company match and company profit sharing contributions. And those contributions amounts can total all the way up to $66,000 for 2023. So what that means is if you max out your 401k plan at 22.5, you can also put up to an additional amount to get you to that $66,000. So when does this come into play for business owners? Primarily, you would see this through profit sharing. You can make an elective profit sharing contribution to boost your retirement savings up to that $66,000 amount. There is a unique strategy that I see some large plans. I would say some large plans here locally, like GE and AT&T. They offer ways that you can do what's called a mega backdoor Roth conversion. So the way that this works is you can put, so for your pre-tax contributions or Roth 401k contributions, an individual can put $22,500 into that 401k plan. Then the employer, as you can see, can contribute, an additional amount to get you up to that $66,000 amount. However, if your employer, let's say they match your contributions, and let's say they put in an additional $10,500 for you. So they throw in $10,500. That way, your total contribution is $33,000, including employee contributions and employer contributions. So you still have an additional $33,000 that you could put into that plan and still be under that defined contribution limit of $66,000. So the way that you can do this and avoid the IRS limit of $22,500 is you can actually put after-tax dollars into your 401k plan. So again, like we talked about, you put in your $22,500, your employer matches another $10,500, gets you up to $33,000. You can actually take after-tax dollars, put an extra $30,000 in after-tax money into your 401k plan. Then from there, if your plan allows it, you can immediately convert that money into Roth 401k, or at the time that you leave the company or retire, you can roll those after-tax dollars directly into a Roth IRA. So that's why they call it a mega backdoor Roth, because you could potentially put 30, maybe 15, 20, 25, $30,000 in after-tax money into your 401k that can then be moved over into a Roth IRA. So something to keep in mind, if you're a business owner and you're in charge of your retirement plan, make sure that when you're setting up the plan, or if you have a plan in place, you can make a modification to it to allow for after-tax contributions to your plan. You can also make a modification to your plan that allows for Roth conversions within that retirement plan. Like I said, if you work for one of these big local companies, AT&T, GE, they offer this in their plan already. But again, for business owners, this is a great perk that you can have to really put away extra money and really to fund in significant portions a Roth IRA. So again, an idea to keep in mind, something to be aware of for your retirement plans. And so the last step to look at is increasing the value of your company. So what are some levers that you can start to pull to increase the value of your company? Obviously, these things, they might be well known, these 7 different topics here, but what are some ways that you could potentially start to implement this within your company? So improving cash flow, you could look at reducing some of your expenses. Like I said, maybe lease things instead of buying them, making sure that you have cash that's available and ready. Another way, if you have cash that's kind of just sitting in a money market or you're not really getting anything from, you can get with your bank and look to put that money into short-term CDs or treasury bills to get a little bit of yield from your cash as a way that you could potentially improve some of your cash flow there. Diversifying your risk, attracting and retaining client, keeping good books in order, increasing profitability, streamlining operations such as inventory management, or maybe it's a certain software that's out there. I know for some people, as your business grows, you may be able to afford better accounting software. So this could be one easy way that you can look to streamline your operations, make things more efficient, and maybe this can cut back on certain headcount that you need, or even hours worked for some people that they can maybe spend those hours doing something different with a better accounting software in place. So again, to add a little bit more context to some of those topics that we mentioned on the prior slide. So increasing profitability, look at your gross margin, see what your cost of goods are. So one of the things that we've seen that happened in 2021, it happened in 2022. Everyone continues to mention supply chain issues. So issues with freight, issues with shipping containers being held at different ports. A lot of the time that was involved in that should be somewhat squared away and should be drastically improved from where it was in 21 and 22. Also, the cost of those shipping containers, from what we've seen, has drastically dropped. Some by as much as $10,000. But the good news is that can help to increase your profitability by some of those shipping costs being down. Other things that I've seen as well, cost of resin that goes into different plastics. So if you're working with if it's a client of yours, it's a business owner, or if you own a business, looking at certain things that are made out of plastic or injection molding can be a good idea, because a lot of those costs are lower in 2022 than they have been in 21, and are lower in 2023 now than they were in 2021 and 2022. So diversifying your revenue stream. So looking at adding different customers, looking at maybe offering different packages. So what ways can you truly get recurring revenue from certain clients? Maybe you have some sort of subscription model that you can do, or a way that you can continue to package your products together or your services together and set them up on more of a recurring revenue model. That not only helps with smoothing out your cash flow, but it also makes your company look more attractive, look more valuable than a one-time sale. So direct to consumer, if you're a distributor, maybe you sell on Amazon, maybe you sell on different retailers, looking to increase your own website sales, selling direct to consumers is a way to not only lower your risk, but also increase your profitability, because I'm sure you get better margins by doing it that way. And then also, one of the things you can do is get with your customers and ask them what other needs they may have, what other products they may be looking to sell, what other services you can look to offer them. You'd be amazed by just taking this simple step of asking the question, asking what else you can do for them, can be another way to add a different revenue stream for your business. So if there's certain services that you can offer them that they did not know, that they were not aware about, or different products that you can maybe get for them and supply them with, definitely something that you can look to do that. I would do that every couple of years as your customers grow and your business grows. So enhancing your product offering. So maybe you sell certain products, maybe repackage those, get a new graphic design, look at ways to even promote your product differently, whether it's Google ads, Facebook ads, YouTube, looking at different ways to package your products together. If you're looking at attracting and retaining talent as well, so having key employees, one of the things that you can look at would be phantom stock shares. So phantom stock is stock that's there, it's in place. It's not acted upon though, unless you were to sell that business. So if you own phantom shares, you don't have things like voting rights, but those shares only become valuable when the business were to be sold, and that's when they can cash in on those shares. And then having your books in order. So if you are, if you're preparing for an exit or any sort of sale, acquisition, really to any buyer, even if it's an internal buyer, maybe you're passing the company on to somebody, one of your partners, or looking to sell it to a strategic buyer, having good books in order can automatically increase the value of your company. Because if you're struggling to find things, or things are too sloppy and they don't know what your true numbers are, that can really start to decrease the value of your company over time. So making sure you have good books in order are vitally important as you're running your business, and it can be a way to increase the value of your company. So another step that you can consider would be deciding to partner with a financial advisor. So somebody that can help you not only with your personal wealth, but then also can help with your business planning as well. So one of the things that we do at Incline Wealth Advisors, we can sync everything into your client portal. We can see your business values and cash flows, and how that ties into your personal plan. So your personal goals, maybe you have goals of funding children's education, buying a second home, moving to a different state, retiring at a certain age. So these are all things that a financial advisor can help you with to serve as that quarterback for, here's your personal plan, here's your business plan, here's how that ties together. Also, that financial advisor can work with your accountant, work with your attorney, make sure you have legal documents on file, trust documents on file, make sure that the decisions they're making from an investing standpoint match up with what your accountant would recommend as well. But they can really be this quarterback for you to help you with both personal and business, and also coordinate with your other professionals that help serve you as well. So thank you for taking the time. We'd love to get in touch with you and sit down and maybe come up with a plan for, what does your personal assets look like? How does this tie to your business? What's the strategic path going forward for each of those? And where are you at today? Where will you be in 5 years, 10 years, 20 years down the road? And those are one of the things that we can help you out with as a financial advisory, fiduciary advisory firm. We work with clients in couple different ways. One of them can be as a flat fee consultant to help you build out this plan, or if you have assets to manage, can help you with the traditional assets under management fee. So appreciate everybody tuning in, checking out the video. If you like this, make sure you subscribe to our YouTube channel. And if there's any questions, feel free, give us a call at the number on the screen or shoot me an email. Thanks again.